Okay, thank you, Curtis. So we're a couple minutes after 2 o'clock. Just wanted to ask if Pete or Jackson or Christopher or Sandy had anything to share to start today. Go ahead, if you do.
It's Christopher. Can you hear me? Great. Hey, thank you all for joining today. We're excited about the topic that we're going to have today, Schedule F, and what that can do for farmers to be more organized and record things properly. We want to thank the Center for Farm Financial Management for their technical expertise, Native CDFI Network for being part of this, as well as Pete at Native 360 and him being chairman of Native CDFI Network. And mostly we want to thank the Native American Ag Foundation for making it possible. So if anyone has any questions, we will leave our contact in the chat, and we look forward to hearing from you.
Thank you,
Great,
Christopher.
thank you, Christopher. Anyone else? Otherwise, go ahead, Pete.
Oh, I have Aaron Kaiser on the call with us today. Aaron is an ag producer from southwest Nebraska, and going to possibly be working with him and his experience in assisting us in our development of our program. So Aaron's on the call, just excited. So
just listening and taking it all in.
Yeah.
I don't have anything to add except that I'm excited to learn about Schedule F. I think this is going to be productive, and I look forward to folks using this today, but also in the future as adding this to a resource library and toolkit. So thank you.
Well, thank you all, and thank you, Aaron, for joining, and our other participants. I would like to introduce Rob Holcomb. Rob is an ag business management extension educator here in Minnesota. He focuses a lot on tax work. I'll let him give you a little more of his background, but we welcome Rob and we thank him for sharing his expertise today. So feel free to chat in questions as we go. I am going to be sharing the handout for today in the chat box, and that'll be made available to you afterwards as well. So thank you all.
All righty. Well, I'll go ahead and take it away. Let me get this screen shared first, and then okay. Now, Pauline, am I coming through okay?
Yes, we can hear you and we can see your PowerPoint, Rob.
Well,
thank you.
That's the best of both worlds then. So facetiously. Well, welcome everybody. When Pauline reached out to me about doing this, I jumped at the chance. I'm Rob Holcomb. Residence wise, here's my contact information. You might want to jot down the email address, which that'll also be in the PowerPoint that Pauline is letting you providing a link for. But I'm located in southwestern Minnesota, affectionately what we refer to out here is the prairie. If you're familiar with the Little House on the Prairie stories, this is, Walnut Grove, Minnesota is all of 20 minutes away from where I'm sitting right now. So we're out on the flat ground. When it snows and it blows, we have blizzards all the time out here. It's just something we're used to. Work-wise, I'm definitely not an early career person anymore. I've been working in the either tax preparation or tax education realm since 1990. So golly, we're in the 31st year of that, how time flies. But I'm not going to say that I've seen everything, but I've seen a lot. I also head up the tax education programs for the University of Minnesota statewide, and I do a little bit of writing for a couple of the national textbooks. So Pauline wanted to emphasize with me that, you know, we wanted to keep this more, you know, more at a producer level, not necessarily somebody that needed to know everything about doing tax returns. And I think we're going to be able to do this okay. Now, questions that come up all the time on this, and I think this is kind of the key thing to talk about when we're talking about this topic. We have to start with, why do we want to keep good business records? Now, when I first started doing these programs back in the early 90s, I started off my career in farm management in that. We had the company that I worked for. I worked at Iowa Farm Bureau for 8 years after I took early I retired early from being a high school ag teacher and moved into farm management. But when I did that, you know, we were trying to emphasize to producers, you know, this is something that you need to do. And it's a really hard sell, because producers, they're not, you know, they're just inherently, they don't want to be sitting at the computer or sitting in front of a record book. They want to be out there doing the farming, and that's what they'd rather do. And that's always the tug of war that goes on with producers and record systems. So I think one of the things that we have to do is we just have to change that way of thinking, that and this is a statement I've made for 30 plus years. The largest potential way to increase net farm income is on the management side. And the only way you can take care of the management side is if you got some records to fall back on. So as far as keeping good business records, you know, of course, we want to monitor that, you know, monitor the progress of the business. The second bullet there is by far the most important. Determine profitability. We need to know whether the farm is making money or not. And then the analyzing part is, well, if it isn't, what can we do to fix it? That's the analysis part of this. Now, also preparing financial statements. We could have put on here as well that, you know, the lender is going to require this sort of stuff for you know, for the, as part of the loan application process. Of course, we want to track receipts and expenses. That's kind of almost a sub part of the profitability, and the tax return and supporting that tax return. One of the other programs I've done was, you know, talking to producers about, you know, the advantages of filing a return and having Schedule F. Well, we tie a lot of FSA programs to, you know, a lot of those are related, you know, under, you know, under the umbrella. You know, if you look at, you know, the workings of BIA and the workings with native producers. I should have also mentioned before as well, couple of the reasons I'm on this is I guess my wife of 30, God, I got to do the math here, going on 34 years. My wife is Cherokee, so I've got some ties to to Native American tribes in that sense. The other thing is that Kevin Clare, who's currently the director of the Center for Farm Financial Management, got me in contact with some folks working on the Navajo reservation several years ago. I've made several trips to Arizona, loved the work. This was pre-sequestration time, and you know, that funding source kind of dried up at that point in time, but you know, absolutely love that work. But I've been involved with working with native producers in the past. Many times with these FSA programs, you got to have that Schedule F in order to even qualify for an FSA program. So that's kind of item number one. And the second thing is the Schedule F in the analysis part of things. It's the building blocks, or we could even say it's the bedrock of determining the profitability of the operation. Pauline, if you're on here, has this group had any talk of any discussion with FinPac yet?
No, we haven't. We talked, I shared FinPack Lite as a resource last week, but we aren't going to dive into FinPack very far.
Okay, all right. Well, I'm mentioning it here, and I just wanted to FinPack is an analysis software program for the University of Minnesota, and when we do an analysis in FinPack, that we start with the balance sheet, but the main guts of the analysis is coming right from the Schedule F. So it's really the bedrock of determining that profitability, and that analysis keys off of that. Now let's talk a little bit about accounting records, and I know we're going to get to Schedule F, but this is the important stuff. Is in order to put that together, we have to have some records in order to tie back to putting that Schedule F together. Now, we live in an era right now where computers don't cost $5,000 to $6,000 anymore. I mean, they're inexpensive options for computers, and a lot of folks are doing computerized records now. I applaud that. That's wonderful. Computerized software is great, and you don't necessarily have to have a high-end, really expensive farm accounting program in order to keep good records. You can do a really good job with Quicken or QuickBooks, and actually you don't really even need QuickBooks if you're not going to be doing payroll. So you can buy a version of Quicken for probably under $50 anywhere, and if you catch it on sale, it can be a lot cheaper than that. But there's a number of off-the-shelf software that will work great for that. You can also be doing a manual record book. Now, I've got the camera on here a little bit. This is probably bad influence, but like here's a record book that I guess I grabbed at this one from the Department of Ag. They have these things at the FSA office, and another one that I have. This is kind of an old takeoff of the old farm credit record book. It's kind of a legal size sheet. It's a legal size sheet, but I'm not exactly a small person, but you fold this thing out, and it's got 20 columns for income and expense going all the way across the board. So manual record books, there's nothing wrong with doing a manual record book. When I first came to the University of Minnesota, I worked for the Farm Management Association. They're headquartered down at Lamberton, which is about 35 miles southeast of where I'm sitting in Marshall right now. But when I think back of the most successful producers that I worked with in that time I was with the association, several of those top producers did not come in with a computer printout. They did a manual record book, and they added it all up. But when we do the analysis, they were year in and year out in that top performing group. So there is no stigma to doing a manual record book. It's just, you need a system, and it's whatever works with you the best. Now, when you're talking about a record system, and I'm going to wrap this up pretty quick and get into the Schedule F bit here. But as far as the record system goes, whether you're using Quicken or hand-kept record book or QuickBooks or any number of different programs, you need to be able to have something that's going to be able to keep track of farm income and farm expense, and hopefully keep that separate from the personal stuff. All right, that's one of the challenges when we get into Schedule F, is that you only want the business-related expenses and income on the Schedule F. There's a separation of the personal and the business. You also want to have a system set up with to track capital assets bought and sold. What I've noticed in my previous experience working with native producers, a lot of these operations are livestock, heavily based on livestock. So that makes the necessity of having to have a system set up to be able to record when you buy and sell, buy and or sell breeding stock, because that gets treated differently. It's still income to the farm, but that sale doesn't necessarily go on the Schedule F. There's advantages to putting it elsewhere, and that's why we're going to talk about 4797 here before I get done as well. You want to be able to track that money borrowed and debt paid, as well as the personal income and expenses. Now, folks, that said, on the record system, I think if you're doing the computer, the thing that you want to start off doing is run everything for the farm business through your checkbook and get into the habit. And if you need help starting, by all means, email me. We'll figure out a way to get you some help. Start off reconciling that monthly bank statement every single month. What that does is that ensures that everything that ran through the checkbook is also in your farm records. And it ensures that you didn't leave a big mistake out of there. In my time, the worst mistake I ever saw, we had a client when I was with Iowa Farm Bureau. We had a client that came in the door. It was a cattle feeder. And one of the things that we always did every year when a new client would come in, we would do a real quick audit of last year's bank statements and everything. And when we reviewed that, we found out this individual had sold $80,000 worth of cattle twice. He didn't catch it. I mean, basically he doubled up on income that he didn't have to report it on the tax return. And it was just a simple matter of if that individual had been reconciling his bank account every month, keeping track of the balance, that's something that would have been caught. And it didn't get caught. On the manual record book, this isn't something I downloaded or anything. I literally took I got my iPhone out and took a picture of that hand-kept record book. But, with the hand-kept record book, all you're doing is you make an expense entry, and then that column that you see on the slide goes out for like 20 columns. It essentially, every one of those numbered columns is a different line number on the Schedule F. So what you're doing is you're sorting everything out so that you can put the Schedule F to order. So if it seems like a lot of Schedule F is the record keeping, you're right. Here's what a computer software program would work. Now, this report happens to be coming out of a program called PC Mars. It's sold through Iowa Farm Business Association. We use it with the Minnesota Association here in Minnesota as well. But this is an income report, and you'll see that it's doing a lot of the same things that adding up that ledger, the manual ledger, is going to do. We had, for instance, on that top line, we got two different sales of corn, and what it's doing is it's giving me, when I run the report, it gives me the total amount of corn sold for the year, total amount of beans sold for the year. And then we've got sugar beets, and don't worry so much about the patronage and the sealed grain. That's another lecture all by itself. Expense wise, we see the same thing going on here as well. We've got, totals for seed, chemicals, crop drying, livestock supplies, fuel, all stuff that goes to the Schedule F. And that's where a good record system really makes easy work out of putting that together. Before I dive into the F, any questions out there? Because we've got a group size that's kind of facility. If somebody has a question, just pipe up. I don't think we have to worry about going through the chat.
I will say there haven't been any chatted in questions, Rob,
Okay.
but
All
yes,
right.
you are exactly
Well,
right. If anybody has a question, unmute and ask.
Okay. All right. Let's move forward with stuff then. So let's now talk about the Schedule F. Now, when you have the top of the form, most of this is pretty self-explanatory when you're looking at the top of the form. It's going to have the name of the operator, social security number, or employer ID number. That's, of course, off to the right hand side. The producer doesn't need an ID number unless they are going to be doing payroll. That's the one case of if they're going to be doing payroll, then they've got to go out there and get an employer ID number. Otherwise, they can operate that with the social. There's a principal crop or activity that you have to report on line A. Now, usually that's going to be if you're a cow calf producer, that's what you're going to write down there, a cow calf or livestock or row crop. You're just indicating what it is that you're producing. And then there's an activity code. We're going to get to the activity code here in just a moment as to where that comes from. You also have to indicate cash or accrual accounting, and then now lines E, F, and G. Anybody that's out there doing farming, and if they're actually doing the chores and performing the farming operation, you are materially participating. So that's going to be a yes, probably 99% of the time. And the other thing it's asking, did you make any payments that you have to issue any 1099s for? 1099s have to be issued for rent or custom hire. Possibly if they had a vet bill in excess of $600, they may have to issue a 1099 to the vet. So if they need to issue 1099s, you need to indicate yes or no on that. And then it also asks, well, did you also file them? So that's what those boxes are on the top there. Now, the Schedule F is primarily used for reporting farm income and expense. So if you have a farming operation, it's going to get reported on Schedule F. On the tax return, if you have a non-farm business that's not incorporated, it gets reported on a Schedule C. C is in cat. So as mentioned earlier, there's two methods of calculating profit, and you basically elect this from the time that you start up your business. You can either be cash or accrual. Now, folks, in the whole time that I've been either in education or practice, I've only had 2 clients that were ever accrual in 31 years. There's not a lot of people out there that are doing accrual, but since it's a checkbox, I'm going to take 30 seconds and talk about it. Cash is the most common way that people are going to file returns, and because it's the easiest. If I sell corn today, I write it down in my checkbook, put it down in my records. I'm going to report that cash transaction as being performed in 2021. So it'll be in the 2021 year. And that's pretty much all there is to it. If I pay a bill today, if I go to the farm supply store and I buy supplies, report it as an expense today, it's going to get reported today. So everything gets reported, income and expense, based on the day of the transaction. All right, it's all based on cash. So, but cash can be a check. It's not, cash doesn't mean the green bills. It means basically, it could be a check, but it's money changing hands either via check or can be with cash as well. Now, accrual.
Rob, can I interrupt you?
Yes, sure.
There's one question that's sort of germane, so I don't want to miss it.
Sure.
The question from Heidi is, if you and your spouse are doing a farm or ranch operation together, whose social security number do you use? So going back a little bit, but
good question. Good question. Now there's the typical answer, and then there's the answer that you can do. There's historically, farming is, historically farming has been a male-dominated industry. I don't think there's anybody that's going to argue with that. In most cases, what's happened in the past is everything just got reported under the husband's social security number, and the wife was just along for the ride. The bad part about that is that then the self-employment tax or social security tax that gets paid is all in the husband's name, and nothing gets allocated to the wife. If you have a husband and wife, a married couple that are farming together, they can file as a qualified joint venture. Now, what that means is the husband files a Schedule F, the wife files a Schedule F, and they basically divide everything in two. That way, stuff is getting reported to each of them individually. but that's something that you can elect on your tax return, basically just by filing it that way. But you are completely allowed under the law to do that. It doesn't require any. You don't have to do any incorporation or any filings with the Secretary of State or anything like that. It's just something that you can report on your return and drive forward. Did that?
Yep. She said thanks, and that's the only
Okay.
question so far.
Okay. All right. Again, let's move forward on accrual. What accrual does, in a nutshell, what accrual accounting does is it takes into account your beginning and ending inventories for the farm. All right. So you really don't change anything on your Schedule F filing, but what you do is you look at that beginning inventory, whatever you had for beginning inventory at the end of the year, ending inventory at the end of the year, and then that ends up affecting the taxable income that you have on your return. Most farmers don't do that. Now, however, when you do an analysis, that's essentially what you're doing. Is you're doing an accrual analysis when we do a FinPack, for instance. Now, I told you earlier there's activity codes, and this is actually located on page 2 of the Schedule F, down towards the bottom. But for instance, if I've got a cow-calf operation under animal production on this screen, I would use code 112111. And that's what I would end up putting in that box B. That's going to be your activity code, and that's important to IRS because what they do is when they're analyzing stuff, they want to analyze all the cattle operations together, and they want to analyze all the cropping operations together, and it is to the producer's advantage to file that properly. Now, once we're looking at this, that's the top of the Schedule F. Now, just moving down here a little bit, I've got some slides that list the line numbers, but I think what I'm going to do is I'm just going to go down everything line by line and explain what's happening here. Lines 1A, 1B, and 1C. Now, those are only for those lines are only used if you're doing purchase for resale. Now, what purchase for resale is let's say that you've got a cattle producer that may be buying, in the fall, they may be buying some calves. And what they do is they put them in the feeding lot and they feed them out to market weight, and then they sell them. All right. That is a purchase for resale, a purchase for resale item. And what we do is you take the cost of that asset and you have to put it up on the shelf, and it stays there. With a purchase for resale livestock, you can't deduct the cost of purchasing the livestock until you sell it. So that's why there's 2 lines here. You've got line 1A, which is the amount of money that you receive from the sale of the market weight steer, as an example, and then we deduct that original purchase cost from that, and then that's what gets reported on 1C. It's the net of those 2 numbers. So the all other sales, line 2, that's going to be your grain sales, raised livestock. That's pretty much everything that's going to go there. It's going to be any farm produce that's going to go there is going to go on line 2. For those of you that are working with a co-op, if you do business with a co-op, you're going to get a 1099 patronage statement or a 1099 PATR, or what we call in the tax world PATRA. That's going to be reported on line 3, either 3A or 3B. Now, some of these lines that you see here, the A lines, which are in the middle of the Schedule F, and then you have the lines off to the right. Sometimes what's reported on the tax form may not be the taxable amount. And that's why there's 2 different lines there. So with your co-op distributions, there can be some cases where not all the co-op distributions might be taxable. So you might report one thing on line 3A and there might be a different number on 3B. Most times those are going to be the same. Agricultural program payments, if they happen to be involved enrolled in one of the FSA programs where they might receive a farm subsidy of some type, that gets reported on line or commonplace to seal or take a loan against grain that you have in storage. And if that happens to be the case, then you report, you have the election where you can either treat that as a loan or you can treat it as income. If it's treated as income, it gets reported on line 5. But crop insurance goes on 6. Custom hire. Now, custom hire would be, let's say you've got a producer and say the producer, maybe has a tractor and a plow or a disc, and the neighbor hires them to go over and do a little bit of tillage work for them, and they pay them for that. Okay, that's custom hire. So as long as it's not a major portion of the income on the Schedule F, it's okay to put that on there. The cautionary note that I always add on this is that if custom hire starts to get over 50% of the amount of money on the total Schedule F, then you start to ask yourself the question, are they really a farmer or not? And that's something that IRS will ask as well. So that's really how we carve out all the different income, and we just add everything up on the Schedule F. Basically lines 1 all the way 1 through 8, and then that goes down to line 9, and that's going to be the total income. Now, got this listed in the PowerPoint. Let's move on to expenses. Now, the expenses is the bottom part of the Schedule F, and income is usually pretty straightforward, folks. Expenses, couple things that I'm going to tell you right off the bat here that we want to watch is in my time, as I said before, haven't seen everything, but I've seen a lot. Been through a few IRS audits, and one thing in an IRS audit that always comes up as a question is the IRS auditor is going to try and carve out, you may have expenses reported here on the lower part of Schedule F. They're going to look for anything that might be of personal nature. All right. So, as an example, for instance, the farmer may have a livestock barn, and they may have a gas heater in the barn. Well, the gas line also goes to the house. So part of that fuel bill is for heating the home. Part of that is for heating the barn. The part for heating the barn is the business portion. We're not allowed to take those personal deductions on the Schedule F. So if there's any way we can, and of course, in that circumstance that I'm describing, it's a common circumstance, but what we have to do is we have to make a good faith estimate, right? Here's the portion that's going to the barn. We're not going to report a business expense for that portion that's going to the house. And I hope that illustration shows that. But IRS is always looking to carve out that personal portion on here. It can include personal expense on here. Now, what I want to do is the next 3 slides. I've got the line numbers here, and I think it actually works better to just go through the lines probably on the slide here. Now that we're live on the webinar here. Line 10, you've got your car and truck expense. Now, the only reason you're going to put something down there is if you're taking an expense on a vehicle, business expense. You can take a mileage rate for business traveled miles. That would get reported there, as well as you can also, some practitioners will actually put some insurance and other vehicle expenses there. I tend to put that on the insurance line and the repairs line. But typically, what I'm going to put on line 10 is going to be either actual vehicle expenses, or you can take the vehicle mileage rate. Line 11, chemicals. That's just going to be if the producer bought any chemicals for the farming operation. Conservation expense. Conservation expense, if you've got expenses for, improving drainage, for instance, if they were to dredge out a drainage ditch, or if they were to do something conservation wise, putting in terraces, for instance, is a common practice. That's going to be a conservation expense. It can't exceed 25% of the income that you've got on the tax return in that given year. One resource that I didn't talk about here that gives you a real good description of all the stuff, all the components of Schedule F that I didn't mention, Publication 225, also known as the Farmer's Tax Guide. If you go to irs.gov, in fact, if you just Google Publication 225, it'll pop up a PDF copy of the Farmer's Tax Guide. It's an IRS publication, gets published every year, and it outlines all this stuff in detail. But it's not this section isn't horribly long. The custom hire. All right, if you hire somebody, let's say if you reverse the situation we talked about earlier, I want to hire the neighbor to come in and do some disking for me. That expense gets reported on line 13. Now, depreciation. We could talk for an hour just on depreciation all by itself. Folks, the idea of depreciation is when you buy a capital asset like a tractor or a disc, or in the case of breeding livestock, say if you bought a bull or bought a cow, those are capital assets. And by rule, they need to be, you can't take the whole deduction in the year that you bought it. Well, there are ways that we can, but under the depreciation rules, we're going to spread that cost out over what is the estimated length of time that the asset is going to last. In the case of machinery, new machinery is assumed to be 5, used machinery is assumed to be 7. Beef breeding livestock, if you bought a cow or a bull, that's going to be 5-year property. So those assets get depreciated out over that lifespan. Now, that's going to require a schedule, and what we're reporting on F is just the one number, but there's a lot of calculations that go into play on this. Now, the other thing that you're going to hear talk of is the current tax law that we're under. We've got ways of taking fast depreciation. And if you've heard of Section 179 or bonus, those are 2 ways that you can write off those capital assets in just one fell swoop, and you can get it all written off, which is going to give you a larger number on line 14. All right, but there's a lot more going to line 14 than what you see here. On the Schedule F, all you're going to see is one number, but there's usually a schedule going on in the background that calculates that from year to year. Line 15 is only going to be affected if you have employees. All right, and they're offering a benefit plan. Maybe it's could be a health insurance coverage, or possibly a contribution to a retirement plan or something. Line 16 is feed. Line 17 is going to be your fertilizer and a line. Freight and trucking is on line 18. Gas, fuel, and oil. And again, that's one of those that they look for. It's only the business portion. So if there's a farm truck and they're taking business use on that farm truck, the fuel for that truck is fine, but you don't want to be adding in the fuel for the personal cars and everything. So that's one of those that takes a little bit of number crunching to get that divided out. Insurance, now this would be your liability and casualty insurance, not health. Interest gets reported either as mortgage or other. Now, mortgage interest is, would be a loan that's secured with property, and you will get a 1098 from the bank, and it'll be labeled as mortgage interest. Now, this is one of those. I refer to as the yellow brick road things. All right, we need to follow the rules on this. You only put down mortgage interest if you've got that statement from the bank calling it mortgage interest, because they will report it that way. If you don't, all interest gets reported as other interest. All right. Never over-report mortgage interest that wasn't already showing up on a 1099. Labor hired, that's going to be wages if they're hiring an employee. Line 23, that's going to be your pensions and profit sharing. You'd have a number there if you had employees and you were, say, if you made a retirement contribution to a retirement plan, that would go on line 23. Rent and lease, looking at line 24, your vehicles, machinery, and equipment rent is going to go on 24A, and land and animal rent is going to go on 24B. So we need to differentiate those in the record systems. Repairs is going on 25. And the good news about this is, folks, is we've got a little more latitude with repairs now than what we did 10 years ago. Earlier in my career, there was always a tug of war with IRS and putting too many repairs down on Schedule F. The reason is if you repaired something too much, IRS did argue in a couple cases, and with clients of mine, they'd say, well, this is too much. It's not a repair. We're going to make you depreciate this because it's a capital improvement. There are new rules on that, new repair regs that give us clear thresholds on what we can and what we can't take as a repair. And that's the next slide that I'll talk about. But let me finish this one out here. The seeds and plants, that's kind of self-explanatory. Storage and warehousing, and that's typically if they were if they were storing grain at an elevator, they would report the storage. Supplies, okay, that's going to be supplies. Not to confuse that with the repairs, but supplies are typically going to be feed has its own line. But for instance, if you're buying baling twine or wire or something along those lines that doesn't fit into the feed or repairs, that's going to fit into supplies. On the taxes, that's now income taxes, federal income taxes don't go here. What taxes we're talking about here is going to be if there's any property tax or any taxes that were paid for business vehicles. For instance, plate fees or tag fees. Utilities goes on line 30. Your veterinary expense is going to go on 31. And then we've got this group down here under 32, other expenses. Now, we don't want to hammer this too much. You can be somewhat vague with what you put on other expense, but it can't be too vague. And let me just give you an example here. When at a previous position that I held at another firm, not affiliated with here, I would review prior year returns, and there would be in the other expense line, they would have typed in on line 32A, other farm expense. And there'd be $30,000 listed on there. And all right, that's too much. All right. It's fine if you got a little miscellaneous thing with a small dollar amount, but odds are if you got big numbers there, it probably could get categorized somewhere else on the Schedule F. All right, it's probably utilities or phone, or the common thing that you're going to see down here under other expenses, professional fees, which would be for that you'd pay an accountant for doing your tax return, or maybe a crop consultant, something along those lines that really doesn't fit into another line somewhere on the Schedule F. Now, earlier I mentioned on the repair line, line 25. Now, what has happened here is we've got new, well, they're about 5 years old now. Tangible property regulations, or we commonly call them the repair regulations. What we have is you've got a safe harbor. So if you bought something and the AFS is an applicable financial statement, that's a financial statement. It's either an audited financial statement or it's a financial statement that you submit to a federal agency, which some producers are going to meet that requirement. Your safe harbor without that applicable financial statement is $2,500. So here's the situation. If you buy a bunch of heifers and to put in the breeding herd, and you paid under $2,500 each for them, you don't have to stick them on the depreciation schedule. You could just expense them out using the repair regulations. What you've got is you've got a $2,500 limit per incidence, per instance to take that $2,500. All right. Now, the remaining portion of this, we kind of worked through all that on the bottom of the form. And again, I guess the couple things that I have had to harp on with my clients before was trying to lump stuff into miscellaneous and dumping it on the other expense. That is something that I don't recommend, because it attracts attention for examination. Plus, it doesn't do us a lot of good. If we lump stuff together in other, it probably could go someplace else. Now, the mechanical aspects of this, looking at this total expense and net profit, we're just adding up all the expenses. That goes on line 33. And we take the difference between the income and the expense, and that goes on line 34. So that's what we're looking at. So line 34 is going to be that net profit. The other things that we're looking at on the bottom here is there's two boxes that you note down here on line 36. You want to check that. That's whether all investment is at risk or some investment is at risk. Typically, for your producer, you're going to be checking box A. What that is there's if the assets aren't at risk by the producer, then there's these things called passive activity loss limitations, and it's typically that's typically only going to apply if you have an investor that's in there and the person farming is really not at risk in the farming operation. Just the bottom line is make sure box A is checked, and I think you're going to be fine, because any of these operations, that's going to be the case. Now, the second piece here that we wanted to look at, this is, and you got this in your Schedule F. You've got this in your Schedule F PDF that I had Pauline attached to you. This is page 2 of the Schedule F, and this only gets filled out if you're an accrual filer. Now, all the numbers basically roll from the front page except for line 45 and line 48. And what you'll notice there is that's going to be 45 was the beginning inventory at the beginning of the year. Line 48 is going to be that ending inventory. All right, so that's really the only two differences on the accrual method. But I mentioned earlier, not many people do that, but it's there. Want to give it just a couple moments here. Okay, let's shift over here to 4797. Now, and there's not much on this. I see the clock here on the 4797. The reason what we report on 4797 is going to be sale of business assets. That's what it's headed as. Now, it calculates capital gains ordinary. It also collects information from casualty losses and installment sales. So it's a very versatile form. But what you're going to see on 4797 is there's 3 parts that go into this. There's part 1 for calculating long-term capital gain. Part 2 is for ordinary, and Part 3 is for sale of depreciable property. What you're going to largely see on here is if you've got a livestock producer and they're selling a raised cow, a cow that they raised from a calf, and they it was a calf that they raised and they put it into the breeding herd. That's raised breeding stock. Raised breeding stock gets sold in Part 1. All right. So if we look at this, that's where raised breeding stock is going to get sold, is going to be on Part 1 of 4797. Why do I bring that up? Well, actually, there's two reasons. Income that you report on 4797 is not going to be subject to self-employment tax. If we go back to Schedule F, the Schedule F, anything we put on Schedule F, we're going to pay ordinary tax and self-employment tax on that. And what we report on 4797, we don't pay self-employment tax on. So a common mistake that I find with smaller operations is I sold a cow, I need to put that on Schedule F. The answer to that is no. If you sold a cow, it's either going to go in Part 1, which is that's where raised breeding stock is going to go, or it's going to go in Part 3, which is where a purchased cow would be sold. All right. So there's only 3 parts for 4797. This is going to be Part 1 is typically you're going to be raised breeding stock is about the only thing that you're ever going to see here, or sale of land. I mean, those are the 2 things that are going to be sold there. Part 2 is if you sold something that didn't meet the holding period, and we're getting a little deep here, I know, but in the case of a cow, the holding period for a cow is 5 years. If you sell a cow before she's 5 years old, she's going to get reported as Part 2. She gets taxed as ordinary. She doesn't get capital gains treatment. If you sold anything that's depreciable, it gets sold in Part 3. But when I'm speaking in terms of breeding stock, breeding animals get reported on 4797, and they don't get reported on F. And there's big time tax advantages to doing it that way, because whatever you put on 4797, you don't pay self-employment tax on. Only raised animals, such as you got that, we've been using that cow-calf producer, that would be calves that you're selling, that would get sold on F. If you're in the sheep business, of course, lambs or feeder lambs that are sold, those are going to be sold on Schedule F. Now, if I'm selling ewes or rams that were out of the breeding herd, they're going to get sold on 4797. I hope that's clear with everybody. But that's why I talk about F and 4797, because there's a big difference between the two and how that income gets treated. All right, I got 4 minutes. Well, no, actually, we got 6 minutes left. I did better than the rehearsal time. So, Pauline, we got anything out there in the chat, or we just want to visit here?
I do have a couple of questions for you, Rob.
Okay.
So, I'll start with, at what point would it be advisable for a producer to amend a previous year's taxes and refile a Schedule F?
Well, you've got, basically you have 3 years from the filing of the return to go back and change it. And a little bit of it depends on what it is that you need to fix, and that's kind of an individual by individual basis. But if for instance if something was major misreported, especially if it's to the producer's advantage, you've got 3 years to go back and amend those open returns.
Okay. Thank you. And then,
specifically, if that individual wants to reach out to me via email, that may not be something we want to talk about, publicly.
okay. Yes, certainly. Anyone can. I know Rob takes a lot of phone calls and emails this time of year, so I think he's very willing to do that.
Lots.
Another question. So this was asked back in the revenue portion of the Schedule F, but I saved it because there's different implications here. So the question is, how about if an ag producer received a PPP loan? So I think really what is, how is a PPP loan reported is how I'll ask it.
Well, with the legislation that was passed in late December, it got a lot easier. Essentially, PPP loans are not taxable, and we do not have to reduce expenses for the amount of the PPP forgiveness. So essentially, it's free money. We don't have to report it as taxable, and the money that you spend on it, you go ahead and report it as an expense on Schedule F. So that, from a producer standpoint, that's all you really have to worry about as far as the reporting goes. Now, the accounting records, going back to that early part that we talked about, when it comes time for the forgiveness, you're going to have records of what you paid for. Did you pay any? There's a portion of that you're going to need to look and see what you had for owner compensation the prior year. If you paid any rent, if you paid any utilities, those are those allowable expenses that go on that PP forgiveness loan. And the best folks to ask for help on that, the lender in this case is really driving the bus. They really have a lot of control over what's happening with those PPP loan forgiveness applications.
Okay. And then one other question. Can you give an overview of the depreciation of qualified Indian reservation property?
That is, all right. I have heard of that. I think that's more of a hard asset. It's not. The individual that asked that may want to drop me an email. I can look it up in probably 10 minutes, but I think the way I understand it, I believe that property classification is going to be more for buildings. It's not so much for machinery and breeding livestock and farm type assets. I think it's more of the assets of buildings and everything. I would want to double check that before I made a final proclamation on that, but I know where to look to find that for sure, but it's probably not too conducive to do that right now.
And I don't. Okay. And Jackson was the one who asked that, so I'm sure
Jackson,
he can chime in or follow up.
Shoot me an email. Shoot me an email on that to remind me, and I can look that up for you quick.
Okay. Yeah, it was just a more general question for the folks. I think some of our ag producers would be producing on reservation lands, like you said, the Navajo reservation, and then some of them aren't. And then I was looking up, I know some of our folks like the Mvskoke nation are in Oklahoma, but Oklahoma is treated a bit different. And I think there's even a special, I guess, classification for the former reservation lands in Oklahoma. But yeah, I just wanted to touch on it, I guess.
No, but excellent question. I apologize. I wasn't prepared to answer that one, but I do.
No worries.
I've read it. I've read it in the material, but I need to revisit that before I can speak with any authority on it.
No worries. All good.
Those are the questions that have been chatted in. I'll say that, but if anybody has other questions, feel free to chat those in yet, or unmute yourself and ask them. We're happy to entertain that too.
One other thing that just a FYI for everybody, the probably one of the best resources that I know of, if you if you are starting your own records or you're helping somebody start their records, uh, Oklahoma State. Now I know Damona Doy put this material out. Now she's now the director of extension down at OSU, but they had a set of, it was a chart of accounts posted on their OSU website that you could import into Quicken or QuickBooks, and it was a farm specific set of chart of accounts. And I'm absolutely certain that's still posted out there, but that's the only place that I know of where you can get that sort of information. But that's on the OSU website.
I did a quick Google search. I hope I'm pointing you in the right direction, but I'll put a link in here to what I think Rob is referring to. So. Okay, well, I don't know that there's any other questions. I don't know, Pete or Jackson or Christopher or Sandy, if you have any thing you want to say or add to today's discussion, certainly feel free to do so.
No, I think it was a great session here. You know, one of the things I was speaking with an ag producer, and on the Schedule F, they have a file system that is created just with tabs so they can put their receipts in just as the Schedule F. So as they go throughout the year, it's just a slam dunk at the end of the year. Everything's already pre-organized for that in case of Uncle Sam looking around.
Mm-hmm.
So that's pretty cool.
You said that was in a spreadsheet?
No, just in a binder, a file. That's how they file their receipts, is according to Schedule F, you know, number one.
Sure.
Yeah.
Sure. Yeah, I've seen those. Those are handy.
Well, I want to say thank you from the Native CDFI Network's perspective. I think we had a lot of content here, and we're looking forward to putting it online. So folks, if they want to go back and look at it as they're going through and doing their taxes, and hopefully it remains relevant for the next couple of years, and then Congress will take another look at the tax code again. But thank you.
All right. Well, you're welcome. Thank you folks for joining us today.
Thank you.
Thank you, everybody. We'll see you next week, and we'll share these resources with you as well.